I'm slightly more bearish probably than Ben is on the euro for reasons I've kind of stated. For example, I don't really buy into this ECB rate hike story. I just don't think, we really need to start pricing that at the moment. We're at 2%. We're not at negative or 0% interest rates. And, there's a lot of optimism priced into the European growth outlook next year. Germany's particular case in point. We saw that Bundesbank report last week, which was particularly bullish. But then some of the survey data from Bloomberg, that's been a little bit more pessimistic. And then also, you've got places like France. Yes, they've kind of kicked the can into 2026. And I think there's a bit of market relief that the political situation is actually stable. Because what the market has been concerned about is the risk of snap legislative elections or presidential elections. So, yes, there's some reprieve on that front. But the actual fiscal situation in France is still, particularly perilous. Because, they're looking to cut their deficit to 4.7% of GDP. These latest measures may get it to 5.3, even 5.4. That's not really an improvement. And, if the euro gets swept up in this, global rate story with rates moving higher, if it does happen, that's not necessarily positive for the euro. Those French funding pressures are going to be even more extreme. And there's been some good work by Bloomberg noting that with France shortening their maturity profile, that leaves them more vulnerable if rates do go higher. So high rates may not even be a positive for the euro if they do come.
OK, yes, that's an important, that link between rates and the sovereign story. Let's pivot to the UK, shall we, Adam, because we've had a lot of conflicting conversations, actually, about gilts. So let's start with your Bank of England outlook. What are you expecting to see there? Because there's still pricing in of rate cuts, but not everyone's quite so convinced.
Yeah, when it comes to rate cuts, I'm more the singular than the plural. I think, we got that rate cut last week, but it was very hawkish in nature. And I think what we saw in the minutes was very telling. So even though we saw that soft inflation data the day before, those contingent of hawks on the boards just aren't willing to budge. They're still concerned about the strength of underlying inflation. They're even questioning whether policy is actually even that meaningfully restrictive. And then in the minutes, we also saw the Bank of England hint that the closer we get to neutral, which, OK, we don't necessarily know where that is, Bloomberg thinks it could be around 3.5%, which would suggest 25 basis points left to get there. But the Bank of England said those decisions are becoming more contentious, which is kind of a hint to say you can't really expect too much more from us at this juncture. And I think you'll see some of the cautious cutters like Bailey, Breeden, they'll move back into the unchanged camp in February.
And Adam, you can play the ref now, because we've had lots of different views on whether we should be nervous about that backloaded fiscal consolidation that was promised by the Chancellor in the budget. The last guest says, yes, you should be worried about it. Where do you land when it comes to gilts?
Well, I wrote a column a few weeks ago being relatively bearish on gilts, so I'm still very much in that camp. I think there's a few things that investors need to be concerned about. Like I just mentioned, they're not going to get support from the monetary policy channel. If global rates keep going higher, that's going to be a headwind for gilts. Then also political risk has not gone away. Yes, there's a bit of reprieve from the budget, but I think the May local elections could be pretty telling. Labour not polling well. I don't think it's unfair to say the market is not in love with Starmer and Reeves, but they're tolerating them. But I think there's a big fear of what could potentially come next if Starmer's premiership is to be challenged. And if you look at betting exchanges, the most likely year for Starmer to step down would be this year. And then, like you said, exactly, the back-ended nature of some of those fiscal measures, that's a real concern as well, because a lot of those are coming in 2029, which would be the run-up to the election. And history suggests that it's not a particularly good policy for a government to start jacking up taxes in the run-up to an election. And then also, some of the assumptions for the OBR, which are underpinning the fiscal headroom, they're particularly optimistic on consumption. And, the UK economy isn't exactly running hot at the moment. And I think there's a Bloomberg article a few weeks ago suggesting that if, the UK economy does falter, these consumption forecasts are not met, that could blow a £40 billion hole in the public finances. And the market just isn't pricing that.